All right. Hello, everyone. Welcome to Greater Bethel's Financial Wellness Ministry. And if anybody's watching on Facebook or YouTube, do me a favor and go ahead and share the post. And I would be extremely appreciative. Again, anyone that's watching on Facebook or YouTube, go ahead and share the post. And I'll be extremely appreciative. All right. I'm going to put it in the hands of the coordinator of our Financial Wellness Ministry, Sister Kiera Hall.
Hello, everyone.
Hello.
Praise you're having an awesome day. I have been doing some studies lately just about the statistics in America in regards to home ownership, interest paid, and give me just a second because Kai is right here crying. Give me just a second so I get somebody to get on for me. Sorry about that. Sorry about that. My kids were supposed to take him back to the room with them, but they went back to the room and left him out here with me. Okay. So yeah, I was looking at the statistics about home ownership and interest paid, and I thought it was really interesting. And then even when we talk about like um families and saving money for retirement, and the dilemma of many people not being able to save money for retirement and being in a position where when they do get to retirement, they are poor or struggling, their money runs out, different things like that. And so I found a solution that I thought was amazing, that can really help people build wealth and take advantage of just saving money and take advantage of the interest they save and getting it to work for them as opposed to working for the loan companies and the big banks. And so when we talk about purchasing a home, as we know, with a standard home loan, hey, I'm in a meeting. You gotta stop it. No, give me just a second. Hey, okay. Sorry about that. Um, and so I'm super sidetracked. What was I saying before Seth was trying to ask me something?
Yeah, some studies you had found a strategy about being able to do something with the mortgage and be ready for retirement or something like that.
Okay. Yes. Okay. I remember now. So I was talking about ownership statistics and how much interest is actually paid. And it was quite interesting. So, like for example, let's say that someone gets a home and the home costs 400,000 and they put 20% down and they get a 6.2% interest rate. Over the total 30 years of the loan, they would have paid about 300 and so they would have borrowed 320,000. They would have paid about 396,000 in interest. And so in total, they would have paid $716,440. And so when we calculate that, a lot of times we look at interest as like APR, like, oh, I got 6% per year. Or, if you got a loan during around COVID, interest rates were at historically low rates. So you might have had a 2 or 3% interest rate. They're up a little bit higher right now than that time. But when you do the math on that scenario, someone is paying essentially 124% interest of the loan just in interest. And so mortgages are front loaded. And so basically what that means is like when you get a home loan, if you look at the schedule of each payment, you'll notice that those beginning payments, most of the money is going towards interest, and then a small part is going towards principal. And basically, the way that it works, and let me just hold him because they keep letting it back out here. So basically, the way that it works is that the interest is front loaded, and it's the word for it is amortized. And so your interest, you begin paying less and less interest over time. So towards the end of the loan, majority is going towards the principal and less going towards interest. But towards the beginning of the loan, majority of your money is going towards the interest as opposed to principal. So anyway, I set all that up because today I want to talk to you about an opportunity where people can actually have their principal paid first and where they can actually be in a position to pay off loans much quicker than your conventional way. And something I thought was so interesting is this concept. As I'm talking with people about this concept, a lot of people are not familiar with it because it's new in the US, but it is not a new concept. Like people are using it in other countries, and then a lot of people use this on commercial investments. And so it may not be used as much on primary, but it's used a lot on commercial investments. So I have a presentation that I'm going to share, and then I will open it up for questions. So let me share my screen. Let's hit share. And where's my PowerPoint? There we go. Should be right on the screen. And let me put this in presenter mode. Yes, please get Kai and keep him so I can present without distractions. Right. Okay. And so I have a mortgage product that I am certified to be able to offer now. And I'm super grateful for the opportunity because I had been learning about this. I heard about it over the years, but never truly understood it. So today, my prayer is that when I share it with you all, that you all can understand it, and that I could explain it in a way that is simple. That's my goal. But I had heard about this product before, and I always thought, how is that possible? I don't get it. That just seems too good to be true. Like I didn't get it. But then when I became an associate in the mortgage broker Patriot Lending Group that I am part of now. My mortgage broker explained it to me, and I was like, oh, I finally get it now. Like that makes sense. And so basically, it's a smarter way to borrow. It allows you to spend less money on debt, own your real estate years earlier, and it gives you 24/7 access to your equity and allows you to fund other goals easier. So, we're going to talk about how this works and what the qualifications for this type of opportunity looks like. And so, just a little introduction about the all-in-one loan. It was developed by CMG Financial in 2005. And basically, it's a loan specifically for single family residences, condos, and 2 to 4 unit multifamilies. It can be used for home purchases and mortgage refinances, rate and term and cash outs. And it can be used on primary residence, second home, and investment properties. And the maximum loan amount is $3 million that you can do with this product. Now, this really puts you in a position to reimagine mortgage. And it's really exciting, in my opinion, because it really changes the narrative. And instead of putting the financial institutions in the spot to where they're earning all the interest and gaining all the wealth, it puts the everyday consumer in a position where they actually are able to own their homes faster. Maybe they might want to buy more properties or have more money in their retirement accounts. It really creates that scenario where they can do that. And I'm going to show you all a real life example from one of my clients. So mortgages, so 84% of buyers finance their home. So most people get a mortgage loan. Most people are not going and buying their house cash. Some people do. And then 62% of households owe at least one. And so mortgages, they're critical. Like without mortgages, majority of people would not own a house and own real estate. So it really opens the door for people to have what we call that American dream of home ownership, being able to get a mortgage. But as we know, when you borrow money, it costs money, right? And so the rates, they drive affordability. And so the lower rate that you get, that allows you to purchase more. because your payment's going to be less. Like, it gives you more buying power. And so when the interest rates fall, the market accelerates. It's like, woo, yippee! Like, we can afford more. And so more people are buying houses, right? And when the interest rate rise, the market slows down. So it affects it. Less buying power, less people buying. Higher interest rates, less buying power. Lower interest rates, more buying power. So think about it. More buying power, more people buying, less buying power, less people buying. But to offset the cost, what borrowers do is they choose lengthy terms. And I don't know if y'all heard the news, but there's now even 40-year mortgages that were out. So we're used to the 30-year mortgage, and they have come out with 40-year mortgages. And basically what that does is it just opens the door for people to be able to purchase homes, because now their monthly payment is at an amount that qualifies and fits within their budget. And so 90% of loans are those 30-year mortgages. So majority of the loans are the 30-year. That's the most popular. If you get a 15-year loan, your payment's going to be way higher. And so for someone whose budget may be tight and they're trying to take care of all the things in life, that 30-year mortgage allows them to get in that home, still be able to take care of all the other things that they have going on financially without so much strain on their budget. And when we look at the debt, the housing debt exceeds 12.2 trillion. Now, let's talk about the retirement crisis. So 50% of households are not saving enough to fund their current standard of living. And so what that means is during the retirement years, people are having to typically reduce their standard of living because of not having enough money to keep up with it, right? And so sometimes people might downsize in retirement. I just watched this very interesting video about 80-year-olds working. And basically, they had to work because they needed to have their basics, and Social Security was not enough, and what they had saved wasn't enough. And so there is a crisis when it comes to retirement and people being able to be comfortable when they get older and not have to be in a tough financial position where they are depending on their loved ones to help them just cover the basics or having to downsize. And so that's a crisis that if you're not aware of, now you are. And so here goes what it looks like with the mortgage. So the average age to start a family is we have 27 for female, 31 for male. So that's the average age to start a family. Yep, I fell around that age range, a little bit younger. Average first time homebuyer age is 33. The average age for all home buyers, so maybe people buying maybe a second or third home, but just all home buyers is 47. So if you think about that, 47, if we put a 30-year mortgage, that won't be paid off till age 77. The average mortgage borrower age is 55. The average retirement age is 64. Average life expectancy is 77. We're super blessed at Greater Bethel because we got lots of people who are around that age and older. And so, maybe your family's living till 80s, but this is just the averages. But look at what's happening during these age ranges. So, between your 30s and 50s, you got children and maybe college tuition and just supporting that family. And then around that age, like in their 50s, that's when your parents are older. So now there might be healthcare needs for parents or siblings and, different things, just taking care of the family, right? And so when we look at someone's budget, the 42% of the monthly household debts are going towards the budget. So almost 50% of income I said towards the budget, I meant the mortgage. So the largest part of the budget is going towards the mortgage. So now we're going to talk about what the mortgages look like. And then the rest is just like all other debts and stuff combined. And so that large portion of your money is going towards the mortgage. And then the cost of financing the real estate is like a huge obstacle. And as we can see, a large portion of that payment you're putting towards the mortgage is going towards the interest. And so here goes, we're going to talk about like pros and cons of the mortgage. So one, we have like our low down payment, right? We have FHA, you can get in 3% or even USDA, 0%, VA. So there's like this low down payment or no down payment. That is amazing. It helps first time home buyers. This was developed in the 1930s, and the common loan doesn't really require like much education. Everybody's pretty much familiar with it. They're like, okay, I get it. Get the down payment, get the loan, make my payments, sweet and simple. It's readily available. There's lots of access to it, and there's so many programs to even help with like closing costs and all type of things. And then payment dependability is just a fixed set payment. And so it benefits those whose budget is stretched. So those are the pros of getting that mortgage. Now, here goes the cons. We know it's slow. It takes decades to pay, 30 years. It's inefficient. The interest costs are paid primarily first within the repayment schedule. So they don't get the interest. So what that means is that's impeding on your opportunity to build the equity faster because the money is going towards this interest as opposed to paying out principal balance. It's rigid. You can't take money back out. So even if you have a home loan and let's say you got 150,000 of equity, you can't just get that money back out. You would have to do another loan, like a refi or a HELOC or a HE loan. You'd have to do something else because you can't just take the money out of your original mortgage loan. And then it's expensive. And so even with low interest rates, mortgages, they cost significant amounts of interest, even with a low interest rate. So this is like the mortgage payment structure. So as you can see, remember how I was saying in the beginning, less money is going towards the principal, more is going towards the interest, but over time, less and less goes towards the interest and more goes towards the principal. So by year 10, for every $100 spent, only $23 is applied towards the principal out of every 100. I like that breakdown because it helps us to really think about it. So for every $100 I got, 23 is only being applied towards principal. By year 21, about 50% of the loan balance remains unpaid. And so rate versus cost. So you got, your home price, then you got your amount financed. We got 360 monthly payments. Let's say we have a 6% interest rate. That 6% interest rate is 116% interest. That's really what that is. And so if you borrow 100K, you are paying 116K in interest. You borrow 200K, you just double it. 300K, you triple it. So that helps paint the picture for like, okay, this is when I borrow. No, put that back on there. When I borrow, now I can see what that actually looks like from an interest perspective. All right. What if you got a 3% interest rate? Like you got that rate, you got the good rate when it was low. And I know plenty of people who got some great rates on their mortgage. And they were able to refinance or purchase during that time and get a good rate like that. And so at 3%, that is a 52% interest cost. So for every 100K borrowed, that's 52,000. And so mortgages, it's just a mathematical equation. And that's what helped me understand what I'm about to share with y'all. Because I'm like, how could the mortgage be paid off so fast? It's just math. So there's only 3 variables that define the cost of the loan. You have your rate, principal, and time. That is it. But everybody likes to focus on the rate. Like that is the focus. I want a good interest rate. Like that is the focus. Oh gosh, hold on. Give me just a second. Daddy, could you give a talk real quick, or just chat, or just share what you're thinking real quick?
All right. Um, so, I mean, like you were saying, uh, I think it's extremely important that we live in the area of purchasing because that begins to build um, wealth. That's one of the main the primary the first way that we're able to build wealth by purchasing a home as opposed to our entire life giving everything away in rent with no equity. But I think the direction that we're heading now is how do you build even more wealth as it relates to purchasing a home? How is it? How do you keep more and pay less to finance, less in the financing cost, which is the interest? But I think Kiera's back now.
Yes, I am back. Bella, please get kind. So yes, so that's exactly it. Owning a home creates an amazing opportunity to build wealth. But what I am going to show you is how to um, do it more efficiently as well. And so when we're looking at so just get out the kitchen right now. Just get out the kitchen. Go. We'll deal with that after I get out of the meeting. Go. So basically, what I'm going to deal with is not just focusing on the interest rate, but looking at time and principle in that mathematical equation and how to get that to work for you. And so basically, what a client can achieve with the all in one mortgage is they can pay their mortgage balance down 2 to 4 times faster without a change in the budget. Without a change. So if let's say you make 10,000 a month, your husband makes 5,000, wife makes 5,000, and let's say that all your bills come up to 8,000 a month, and that leaves you with 2,000. That's just kind of you're able to save, and it just sits there. To pay down your mortgage 2 to 4 times faster, I am not proposing a solution where you pay an extra thousand more mortgage. What I'm saying is you make the exact same mortgage payment, and I'm going to show you how. What the other thing that a client can achieve is they can reduce the monthly and lifetime payments by tens of thousands of dollars without depending on lower rates. And so rates are something that we can't control. And so what I'm wanting us to do, I mean, obviously you can have a good credit score and do different things to help get a better rate, but the best rate is going to be the best rate. And no matter how good your score is, you can't get better than the best rate, is what I'm saying. And so I want you to open your mind to more than just interest rates because this product is about so much more. So that's a quote by Ellen O, one of the top real estate professionals. And also, what clients can achieve is they can have access to home equity in dollars. So let's talk about it. So the all-in-one loan, basically what it does is it combines your mortgage principal and personal banking. And so when you get the all-in-one loan, they allow you to have a checking account that is connected with it. You have 24/7 ATM access, personal checks, online banking, mobile banking, client services, basically all of your typical stuff you get with a bank, you get. But here's why you would want to get this loan and use the account that comes along with it. Basically, your checking account is the birthplace of your net worth. Why? Because all the money you make, it stores all of your income once it's received. And so more money will pass through your checking account in 5 years than the amount typically owed on a home. More in 5 years, more money will pass through your checking account than the amount typically owed on a home. And so you have your deposits, your income, they're going into your bank. And so money floats. We don't it is not typical that someone makes the money and it's all gone the exact same day. That's what I mean by money floats. It sits in your accounts for days, weeks, sometimes months before being spent on bills and expenses. And so when the money that sits idle for weeks, think about it. We're getting groceries weekly, entertainment, dining out. Monthly, we got our gas, cable, cell phone, credit card. So that money's sitting there for a whole month. Maybe quarterly, we have our insurance premiums or travel expenses. Semi-annually, we got property taxes, family vacations, dues. And then annually, we have income taxes, membership dues. So we have this money that we pay out, but we don't pay it all out at once. It sits, we save, it flows. Money can sit idle. And so what this does is those deposits, they're earning, what interest do we earn on our money that sits in the bank? Like, what is the interest rate we're getting? I wonder. I know it's probably less than 1%, right?
Like 0.03. 0.3.
0.3. So 0.3, not even 1%. That is what we're earning on our deposits. And so with the all-in-one loan, it does a strategy called sweep banking. And so with sweep banking, what it does is deposit is, think about like when you're sweeping and you just sweep up the dirt and then you throw it away. Your money is doing the same thing with interest. Instead of it just sitting there and doing nothing for you, when you have an all-in-one loan, the interest is calculated daily. And so what that means is every day your money is sitting there is a day that you save money on interest, which hope that was clear how it worked. Like, it made sense in my head, but I am trying my best to explain this in the most simple way possible. The deposits lower the principal. So let's say you have $300,000 home loan and you get paid once a month, and let's say that paycheck is $10,000. 300,000 minus 10,000 is 290,000. So on that day, the interest that you pay is only on 290,000 as opposed to 300,000. In a traditional mortgage, you don't get that benefit of that daily calculations or paying interest on a lower amount. But in this, you do. And so the interest is calculated nightly, 365 days in a year, and monthly interest payments aren't due until the 21st of each new month. It basically is keeping your money hard at work for an additional 20 days. So your money, like, you're saving interest. This is the only loan that recast interest costs daily to engineer the lowest possible monthly payment. Now, you have money that's not needed for regular expenses. What that does, here, Bella, can you please get Kai or give him to Nyla, please? Because he's moving a little bit too much. And can you keep him back there? Because he keeps finding a way back out here and it's distracting him. Okay. All right. And so money, just get him some cereal to snack on. And so money is not needed for regular expenses. And then money, your equity is the money. Oh, I'm getting so sidetracked with all this stuff on. But basically, your equity is higher. Let me just move forward. Because I lost that train of thought and I forget where I'm trying to get. But your bills and expenses, you still are paying them like normal. Your mortgage payment, you're still paying like normal. But the money that's sitting in the account in between time, like I showed on the page before, is calculating a lower interest payment for that month. And I'm going to show you a real life example so you can just see it. And so basically what this does is it's a creative way to do a HELOC in a first position, but it's not like a traditional HELOC, because with a traditional HELOC, you would not get that sweep banking effect to where every deposit is basically allowing a lower interest to be calculated and then having access to the money like normal. And so what you can see is when you have, and I won't get too deep into this, but basically when you have your all-in-one loan, in the beginning, what happens is your mortgage payment goes down. And in order not to create not your payment, your mortgage balance goes down. And in order not to create new debt, there's like a 20-year credit reduction period to where basically the limit or allowable money that you can access from the equity is down. Now, there are alternatives where you can continue to access all of the equity in a strategy where maybe they're leveraging their home to invest in new property, pay that off quick, invest in new property, pay that off quick. There are a variety of strategies and ways that this can be done. But basically, with your standard, you take the entire length of the loan and then the available equity to access and use reduces down till we get to the end. And basically it's like there's no equity that you're accessing, but also the mortgage is done as well. If that makes any sense. And so your payoff date is here around year 10. In some examples I'll show you, it's actually year 6 where it's paid off, a brand new 30-year mortgage with this particular client of mine. But your payoff date is around year 10, and that varies per person, but in this example is year 10. And what it's showing is that between payoff date and end of the term, you still have access to all this equity, but the access just gets lower over time of being able to use it. And then if you want more access, then at that time you would, request it and go through the process to get more access if you want to basically get a new loan and use more money for home purchases. But during that time, somebody might say, oh, well, my balance is low, but you know what? I want to pay for my kids' college. And now the balance goes back down. And it's like, you know what? I want to buy a rental property. And now it's paid off through this process. And it's like, oh, I got a medical expense and it's paid off. And so it gives you the opportunity to not only pay off your home faster, but at a better interest rate, be able to do other things that you might want to accomplish financially. The banking platform is consolidated. So some people, they try to implement this strategy or do it, but it's not as efficient, and it's like this daily thing that you have to watch. Like it's not automatic. Like you're constantly maneuvering, constantly watching, constantly strategizing. And I think that's what made the concept confusing, and most people kind of stay away from it. And so what CMG did was they created a product to where it's consolidated. It's simple. Basically, when you close, within 48 to 72 hours, your account is set up. And then 2 to 4 weeks from closing, you receive all the banking features and you're able to start your process to accelerate your mortgage payoff. Now, who can qualify for this? This get into the details. So you do have to have good credit, at least a 700 credit score. Also, another thing that I'll say is you do have to have some reserves, like money saved up, and the debt to income ratio can be at 43%. And so maybe you're looking at this and you're like, man, this is amazing. I want to be able to pay off my home sooner. Maybe your debt to income ratio is not at that 43%. No worry. Like get your regular mortgage, own the home. This could be something that maybe you look at a year, 2 years, or 3 years after getting your home, after you working, paying off some debt, getting some things in order, saving up some money, getting yourself in position, then to be able to qualify for this product. So now that I have gone through this, these are just limits, all the way up to 3 million. Second homes, investment properties, won't get too deep on all these particular details. But what I do want to do is I want to go to an interactive simulator and I want to show you real life numbers. So I did this scenario And I'm going to show you the all-in-one versus the loan that my client has now. So basically my client has a 30-year mortgage, 6.62% interest rate, $289,000 loan, and it's brand new 30-year mortgage. So this is the all-in-one loan with their budget, their positive cash flow versus this works for people only who have positive cash flow. If you're paycheck to paycheck, this strategy won't work for you. And so in the meantime, it would be figuring out how to reduce debt, increase income, and get in a position where this strategy can work. This only works for people who have positive cash flow, meaning that your income exceeds your expenses. Not your income and your expenses are exactly the same. But in this scenario, when we look at the comparison loan, we can see that month one, $255 is going towards principal. The mortgage payment is like almost $1,900 a month. Then month two, $511 is going towards principal. Month three, $769 is going towards principal. Month four, and so that's how it breaks down as far as, I'm sorry, not going towards principal. That's how much principal is paid. Please forgive me. So 2,552 of the principal is paid. 511 of the principal is paid of the monthly payments. And then I want to scroll down to the breakthrough where we can look. It happens at month 91. So by month 90, we can see that, the entire, 278,000 of principal is paid. Then by month 91, there is no loan balance. This is the all-in-one. 91 months, how many years is that? That's 8 years and 6 months. 8 years and 6 months. What would have been paid off in 30 years with just making your regular payments is now paid off in 8 years and 6 months because of the lower interest is paid and more money going towards the principal. But we can see in those 8 years, our loan balance with just a standard loan is still $258,000. Remember, it started at $289,000. It's still $258,000. Then if we even go to year 20, it's still $172,000 of the loan balance left. Only $116,000 has been paid towards principal. And then, of course, we go to year 30. It's a 30-year mortgage. Then finally, the entire principal is paid in 30 years. And so this strategy, I hope that I made it clear, but I just want to open up and see if anybody has any questions for me. And then, of course, we know that every scenario is going to be different. Like the more positive cash flow somebody has, the better this is going to work for them. So you have your entrepreneurs. Let's say you have somebody who owns rental properties. You can even allow that income that's coming in for your rental properties to offset interest until you go to make the payment. And you can begin to pay off multiple things way sooner. But this is for people who have positive cash flow. It's a game changer. I've even seen it be amazing for people who even have just $500 a month positive cash flow. So it's not even people who have 2, 3, 4, 5,000 extra a month. Everybody's not in that situation, but I've seen it work. If you're looking at it and you're like, I wonder if this could work for me. I wonder if I qualify. The question would become is, do you have a positive cash flow? If you do, then it would be worth it to get a free, analysis. Basically, you would meet with me. I would go over, log your budget with you and figure out, hey, how much income is coming in? How many expenses are going out? And then we would see, okay, what's that difference? And then we would look, okay, what's the mortgage? What's the interest rate? How many years are left? And then I could run a comparison scenario for you. But this is literally an opportunity for people to, I'm so excited for my client. Like, imagine, and this person was making the extra payments and putting themselves in the position so they could pay it off sooner. And now they could be out of their mortgage in less than 10 years, making the same payments. This client is going to be able to have, actually, I'm going to get my screen back up because I want to show you something else that's exciting that I didn't show. Now, if we go back to the results, I want to look at my wealth accumulation. Look at this. Because this client gets out of their mortgage sooner with the all-in-one loan, that helps them have an extra 1.6 million for retirement. Like by the end of that regular home loan time. So it's an opportunity to not only save interest and get out of a mortgage sooner, but it is a solution for the retirement crisis that we have to help people be able to say, you know what? Now that I'm out of debt, I can dedicate more money towards my retirement savings, and now they can dedicate it sooner. And this is so exciting because now not only is home ownership possible, you build wealth when you have a home and you build equity. But now you're saying that I can build my equity faster. I can build wealth faster because instead of paying the interest first, I could pay the principal first and have more of my money working for me as opposed to working for the mortgage company and the banks. It's amazing. And I'm just grateful to God that I was able to, make a move. For those of you who don't know, I made a move a month ago. God was leading me to make a change. I had been with my company for 8 years. I was helping clients. I'm always been about the mission of building wealth and helping clients save money, making sure they have insurance, helping people become homeowners, first time home buyers. I work very hard, helping clients know about things like and all down payment assistance. I'm SHIP certified. It's always been my heart to help people. But now I am so grateful that I made the move, because when I made the move to leave my old company, God opened so many doors for me. I have so many more products now to help people. Last month I talked about the critical and chronic illness benefits. And now this month I'm able to talk about the all-in-one mortgage, which I didn't have access to before. But now I do, and I'm just so grateful for it. And I'm so looking forward to changing lives, helping people build wealth, helping people get out of debt faster and take back charge over their finances. So that is the end of my presentation. Does anybody have any comments, questions, or thoughts that you want to share? And I'll make sure to drop my contact info if you want to be able to get a complimentary consultation and either see if you can qualify for this, or, even if you don't think you can qualify, like I do free consultations. Like I will help you know what you need to do to qualify. Like I'll let you know, like, hey, this is where your debt income ratio is. We need to get it here. These debts would need to be paid off so that you can qualify here. And then let's say your credit score is at a certain point, I'll be able to say, hey, in order to boost your credit score, we want to get those credit balances lower, right? We don't want to be maxing out the credit cards. We want to have it below 30%. That's going to drive your score up every month. We want to be making those on-time payments. Hey, we want to let's get a good solid budget in place. That way you can start moving towards, maybe you can qualify for this opportunity now, or maybe you can start working so that you can qualify by getting that debt to income ratio right and getting that credit score up so that you can qualify and be in a position to save hundreds of thousands of dollars in interest and pay off your mortgage 10 to 20 years or more sooner. So anybody have any questions or comments or thoughts on what I've shared this evening?
Yeah, so I guess so. If I'm not sure if I completely understand it, but from what I grasp from it is that so banks make money when we have money sitting in there, and so when we have money sitting in the bank, banks make money. And so some banks will go to the point to where you'll have to have a minimum balance at all times, or you'll have to pay a monthly fee. And so in order to keep your money in the bank, if they're not making enough money because your daily balance is not high enough, what they'll do is they'll charge you a monthly fee to get some type of income off of your money sitting in there. So they make money off of your money sitting there. So when I hear this, I think I look at it as this can be beneficial. It's not only beneficial if you have a positive cash flow, but if you can figure out a way to be disciplined, um, to have a healthy balance. And so when I think about, so somebody might, you might have somebody that they may only make $2,500 dollars a month, but then their expenses, might be, $2,300 a month. And so there's not a huge gap. But if they're disciplined enough, there's some people that get like a whole lot of money back on tax returns, like like $10,000 and stuff like that. And so if you're disciplined enough, instead of taking that big bulk of money and saying, let me go and get something. Let me go and be a consumer with this money. If you're willing to sit that money there, if you say, okay, you could invest it also. I mean, you got CDs, to 7 month CDs, you can get 6%. But if you say, if with this program right here, if you're willing to just allow that money to sit in there and see that what this does is allowing that money to sit in there, it's causing this drastic decrease because they're lowering my rate based on the amount that I have sitting in the bank, because that's still a positive cash flow, even though it's not constantly coming in. It's sitting there.
Yes.
It's showing a balance. And so I might not have a real big positive difference between what my expenses are, what my income is. But if I have a lump sum that I can be disciplined enough to just sit, let's say sit the $10,000 instead of going and buying a car or whatever, sit that $10,000 in the bank, because they just want to see the balance. They want to see the balance because they make money off the balance. It strengthens their ability to do a whole bunch of stuff because of what they have, all of their assets. And so it takes, in addition to have good positive cash flow, I think if you have the discipline to be able to take lump sums of money that you're able to get, and then be disciplined to not touch it, to still live your life, this is something that could probably still work for you, even though, I mean, you still got to have that income to debt ratio. But even to get a credit card, all you got to do is have a 30% income to debt. And so that 43% seems kind of high, but if you live a pretty disciplined life, it's not really high. And so that's a way a person that might not have a huge income can participate in something like this right here, having the discipline to where you get that big lump sum to not have a plan to spend it, and to let it sit right there so that it can begin to decrease your mortgage and you can benefit.
Yes. And another thing, so I'm so glad you mentioned that, because it's not just about the monthly deposits, but it could be, the one-time deposits, like that tax refund, or maybe a end of year bonus, or different things. That also helps as well. And I didn't mention that. Um it's amazing. Like it's powerful. And they use this type of loan in other countries. And so it's not something new. It's just not, it's just haven't been used much here in America. And so I'm super grateful for CMG, like taking the time to, study the market and see what's going on and help people. But yeah,
Yeah,
that's a game changer. 30 years to 8 years and paying off a mortgage. And now that's $1,900 a month that you don't have to pay no more. And even, some people might think, well, maybe I'm not going to stay in my home for 30 years. Maybe, because some people, they buy a home and then 5 years later they sell it or they move. This works for you too, because think about it. Up front, more money is going towards the principal. So that means that by the time you sell that home, you have more equity in it. So it doesn't even have to be a 30-year pay off the home. It could even be maybe I'm only here for 5 years or 10 years. But if I can pay more towards my principal, that means that I am going to have more equity. And that means that when I do sell the home, then I am going to benefit even more from the equity that grew on my home because more of my money was going towards the principal as opposed to interest.
And it's probably not a since it's a whole package, bank
Right,
bank deal. It's not just what's in checkings. And so, like
right. It's
say for my
everything.
yeah, say for myself, I put a pretty large deposit into savings every month, and even though savings don't make a lot of money, but I can use that savings to do other investments whenever I want to. But I put it over there so it's not like something that I see that lets me know, hey, you can go and spend this, you can go and spend that. And so I put that over there. So even with this right here, if there's a automatic monthly transfer that you do into your savings, that's still a part of your whole bank package.
Exactly.
And when you put it into savings, it's not staring you in the face to where you can say, oh, I can do this to make it. It's almost out of sight, out of mind. And so, but you just have to be disciplined
That's the key.
to be willing not to touch money, knowing that it's actually working. And so in this way right here, I got it working this way. If I did something else with it, I could work it another way. But just knowing that your money is working for you instead of you just spending all of it waiting for the next check, that this is actually working. I don't see it right now. But this right here is actually going to make me, instead of spending, $700,000 on my home, only spend, 400,000, $370,000 on my home in the end. So this right here is really going to help me out when I'm ready to retire. Because now I don't have that mortgage. Like my mortgages are set to be paid off when I'm 69 because I want to retire at 70, but imagine if I would have had my mortgages set to retire, at 50, 9 years ago. And so these are you just got to look at it way. I'm trying to make sure I'm sacrificing a little bit now, so that I can be comfortable later.
Yeah. And I think the most exciting part about it is it's not your typical scenario to pay it off faster. It's not like, okay, I make this much and my mortgage is 2,000, but now I'm paying 2,500 every month for my mortgage. It's being paid off faster, still making your regular mortgage payment. And it also leverages. So one of the things about this loan as well is how you have taxes and insurance. And taxes and insurance are not due monthly, but they collected in escrow in the mortgage month. But in this product, what they do is they actually allow your taxes and insurance to benefit you as well. Because let's say those tax and insurance is due semi-annually or annually. Now that money that is sitting there that normally would have been paying tax and insurance, that is cutting the interest costs until it's time for that to get paid. And so I thought that was pretty amazing as well. That the even the just your typical bill of tax and insurance that you're going to pay is now offsetting interest for you as well.
So you're not with your checking account because they're definitely making money off of you with your banking account. But when you strategize, you can cut the money they make off of you, and so essentially you're making money off of them too, as opposed to doing it the normal way. And so you're utilizing your resources to also make money, and making money might just be that I'm paying them less money, but that still means it's still more money in your pocket.
Yep. I like to say a dollar saved is a dollar earned. So if for every $100, if I owe 5% interest, that's $5. So it's like, to me, not only did I save $5 on every like, if you save $5, you just earn an extra $5 that you didn't realize it. But a dollar saved is a dollar earned. And so I hope that wasn't confusing the way I said that. But saving money is powerful. And yeah, this product is a game changer. It's going to help so many people. And there's people who already do this. Like last month, I played the video of Myron Golden, and that's who I heard about it from. And I was like, how? How? What is he? And he was like, yeah. And then I met another person. I'm like, how in the world do you make the same regular payments but pay off a $600,000 home loan in 6 years? Like, just I couldn't get it until I saw the breakdown in the chart and the interest save and realized that what was happening in traditional loan is majority of the money is going towards the interest up front. But then in this loan, you're actually paying the principal first and you're cutting back on that large interest payment that you typically would have in a traditional loan. Like we said, if it's a $300,000 loan, you might be paying over 30 years over 300,000 in interest, depending on your interest rate. Like 6%, you're gonna pay over 300,000. If it's 3%, you're probably gonna pay about half of it, so about 150,000 in interest, and you're able to save majority of that.
I think when you're talking to God, I think you just need to pray for God to transform the way you think, because it's really about a mindset. And so some people live life with the throwing up the money in the club mindset. So I have a whole bunch of it, and it doesn't really bother me to throw it away. And some people, they might have a lot, but they still want to save. I think about my wife, about Michonne. I mean, she's always, man, all these coupons and stuff, and I pick at them like, Michonne, you ain't got to use these coupons, but she's going to use them coupons. She's going to see how much she got when she go to that register to see what she got available when we in CVS or Walgreens, and she's going to use that stuff. But I think it's about a mindset. So even though she might not need to, in her mind, her mindset is to, if I can save, I'm going to save, and so I think we have to pray to God for a mindset. And so even where this right here, it's saving at a whole different level. But you gotta learn how to be faithful in a few things. And then God can give you the kind of mindset to where when he brings the larger, you got the mindset to where now the larger works. And so I think we have to just pray to God to give us the kind of mindset that enables us to live a disciplined life, knowing that we are not just living for today, but we're trying to manage our lives to where we can set up our children's children, because we were able to be disciplined. And then there's some people that have a lot of money that's going to be able to bless their children's children, but because they were so reckless, they probably could have blessed their children's children, if they would have just had the right mindset. And so I think we just pray to God for that type of mindset, and then God can use you to do anything.
Amen. Amen. I want to close us out with just a couple of scriptures and quotes to think on. The first scripture is Proverbs 22:7 NIV, and it says, "The rich roll over the poor, and the borrower is slave to the lender." Basically, I think the way that we can apply this is realize that debt isn't just a bill. It's a form of servitude that dictates where our time and energy go. And so speeding up repayment is about regaining your freedom to serve God rather than the bank. The second scripture I want to share is, "For which of you desiring to build a tower does not first sit down and count the cost, whether he has enough to complete it?" And so the way I think that this applies is, it says, success in this strategy requires precision. You must count the cost and map out your cash flow before you start moving money. And then the next scripture is Proverbs 13:11. "Dishonest money dwindles away, but whoever gathers money little by little makes it grow." And that scripture kind of makes me think about Michonne and what you said of just being mindful. And it says, you don't need a windfall to get out of debt. You need a consistent, efficient process. Another name for this all-in-one mortgage, some people call it velocity banking, but it's the little by little that creates massive growth. It's that little by little and saving that interest that creates massive growth. The next scripture is Proverbs 13:22. This is one of my favorites. "A good man leaves an inheritance for his children's children." So by using your cash flow more efficiently today, you are reclaiming the inheritance that would have gone to the bank's interest and keeping it for your family's future. And then my dad, I love how he pointed out about Michonne being frugal, because I'm reading a book about like a wealthy mindset, and rich people are frugal. It says wealthy people don't just see $100 bill. They see the 1,000 that money could become if invested for 10 years. When they spend 100 on something unnecessary, they feel the loss of that future wealth. That is called opportunity cost. Wealthy people are frugal about depreciating assets, cars, clothes, and gadgets, so they can be aggressive about appreciating assets, real estate, stocks, and business. They would rather drive a 10-year-old Toyota and own a 10-unit apartment building than drive a Ferrari and rent a condo. Another quote says, true wealth is not about buying things, it's about buying time. Frugality allows a person to build a buffer so they never have to take a job they hate or answer to a boss they don't respect. For them, the peace of mind of a large bank account is more pleasurable than the thrill of a luxury purchase. As most people earn more, they spend more. The rich stay rich by keeping their expenses flat, even as their income rises. The secret formula, wealth equals income minus expenses plus time. If you keep your expenses low, that's frugality, the wealth builds exponentially faster. So thank you all for tuning in. I hope that you are blessed by this meeting today. I pray that we all can have wealthy mindsets. And if you want to learn more, feel free to, call me or text me or email or reach out to me. And yep, I'll put my contact info in the comments on the social media. That way, if anybody wants to reach out, they can.
Perfect, Kiera. We thank you for some extremely good information. Elder Mabel Kuhn commented, great. Mabel Kuhn Manning commented, great information. And so as you're listening, you run across this, share it with somebody. If we can learn to be disciplined, with the right mindset, which we can give to God. God said, if you want to ask for it, and He'll give it liberally. And because once you get that mindset, there's no limitations on where you can go. But you got to get the right mindset, and then God will do the rest. So Kiera, we thank you so much for the information, and you all have a wonderful, wonderful holiday. God bless you and God keep you is my prayer.
Thank you.
Thank you. God bless everybody.